As we as we wait for people to still come in, reminder again, even though you probably don't need it at this point, that the quiz is on Monday, first 30 minutes of class. Okay. So please don't be late. If you've registered at the Moses Center, you need to let them know you're taking the exam. It's not just enough to register. So if you're in the Moses Center, make sure you let them know that you're taking the exam there, because it's easier if you take it there rather than here. Right? If you have no idea what I'm talking about, just let it go by. So today we're actually, I'll give you up front. Today is going to be a pretty intense day in terms of pieces coming together. So I want to warn you ahead that that's going to happen. But we're going to build on what we started last session, where we talked about betas being weighted averages, right? And I suggested that you look at your own portfolios. You're saying, well, there's nothing in my portfolio. There's obvious, that's fine too. But if you look at your own portfolio and you look at what you have, you can get a beta. So let's say you have a third of your money in the Vanguard 500 index fund. What's a beta? It's going to be 1. Let's say you have a third of your money in T-bills. The beta is going to be 0. But for all of you, there is an item on your balance sheet that is not going to show up right now, but it's all about the, remember, corporate finance is all about the future, right? So if you were doing a forward-looking balance sheet, for most of you, what's that missing item on your balance sheet? Why are you in an MBA program? Not for the intellectual curiosity, I would hope. This is not why you come back for MBAs. It's because you want to increase your career earning power, right? Your biggest asset that's not on the balance sheet is your human capital. Do you think different jobs have different betas associated with them? I was going to say a government job pretty has a low beta, but right now that might not be true. Yeah. But basically, you pick a job, it comes with a beta. Talk about risk return trade offs, right? When I see people picking jobs purely based on pay, I sometimes wonder whether the class kind of slipped by, because there's a risk return trade off. You can go work as a trader at a hedge fund and make $350,000, but it comes with a higher beta because you're very sensitive to what the market might be doing. So think about it. It's something to think about. We all have personal balance sheets. We all have risks associated with them. We've got to manage that risk over our lifetime. And as we have dependents and children, and those things have to be play a role in what you invest in and what jobs you might decide to have given the riskiness of the job. Today, though, I want to bring that weighted average concept to looking at companies. Remember this entire process, I know we keep forgetting, and I keep reminding us to come up with a hurdle rate for a company. We came up with a hurdle rate for Disney. We took the risk-free rate, the equity risk premium, and then we used a regression beta. And I said, look, I'm using it, but I'm not quite comfortable. This is not a number that I want to build an entire analysis on. And I want to give you an alternative to regression beta. So by the end of today, that regression beta you printed for your company, those of you did, I wanted to set it aside, but because this point on, the beta you will use for your company will be based on what we talk about today. Betas are weighted averages. If you look at a company is a collection of projects, right? You have project 1, project 2, project 3. If you take the weighted average concept, every project has a beta. So if one of your projects is a contract with the government, the beta might be close to 0. So if you take Palantir, it's 2 businesses, right? One with the government, one with commercial businesses. The beta for the government business might be lower, the margins might be lower as well. Each project has a beta. So if I ask you to estimate the beta for Disney and you take every single project, this is going to be a nightmare. Every movie is a project. I mean, think of the hundreds and hundreds of projects. So to make this manageable, here's what I'm going to do. I'm going to bundle projects together based on the business. All the movies go into the movie business. If you want to break it out to action movies and animated movies, you can do that, but you want to bundle it. You do this because otherwise you face this really impractical problem of getting betas for projects. So today what we're going to do is we're going to break companies down by businesses and build up to a beta for the company from those business betas. Lots of estimation questions along the way. But I'm going to offer this as an alternative and argue that this is a much better way of estimating a beta for a company than running a single regression, taking the slope of the line and saying that's a beta for my company. So let's take a look at the process we're going to go through. I want somebody to remember, Ravi, you can be my guinea pig. Start a company and you can get into any 2 businesses you want. Pick 2 businesses. AI is not a business, so let's be very clear, right? So AI, so tell me what kind of AI are you going to do? Is it going to be entertainment AI or it's going to be business AI? So you're going to be an architect. So basically you're going to build the AI, so you're going to go up against NVIDIA, you're going to make AI chips and tobacco? Okay, good. Very different businesses. So I'll be back to, so people are saying that's a strange combination. Hey, why not? You smoke and then you make AI chips, right? It could be cannabis and AI. That could be a lot worse. Or alcohol and AI, in which case, I don't know what chips you're making. Maybe it's potato chips and you're selling them as AI chips. So here's what I'm going to do to get the beta for Ravi's company. I'm going to go back to my office or to my computer. I'm going to find as many publicly traded chip companies as I can. I might not be able to find AI chip companies. There aren't enough that call them. But there are lots of semiconductor chip companies. Let's say there are 50 of them. And I'm going to find as many publicly traded tobacco companies as I can. 100 of them around the world. Okay? They're publicly traded. What can I get for each of them? A beta, right? So I can get a beta for each company. I'm going to average the beta for the AI chip companies and average the beta for the tobacco companies. Hang in there. I now have an average beta for a tobacco company and an average beta for a chip company. Those are regression betas, right? When you average a regression beta, you get a beta with leverage. And I don't know whether Ravi chooses to use debt or not. That's a choice. So to take out the effect of debt, I'm going to unlever the 2 betas. What I'm going to end up with is an unlevered beta for being in the tobacco business and an unlevered beta for being in the chip business. Then I come back to Ravi and say, look, you told me you were in 2 businesses. Tell me how much of your value you get from each. And his reaction might be, I don't know how much value I get, but I can tell you how much revenue I get. Let's start with that, right? It might not be perfect. It's not value. But let's say you get 75% of your revenues from chips and 25% from tobacco. I take a weighted average. I now have an unlevered beta for Ravi's company. I ask him a final question. Do you have any debt? If he says no, I'm done. That unlevered beta is now the levered beta for equity but if he does have debt, I'm going to compute a debt to equity ratio and re-lever the beta up. So this word unlever and re-lever, pick your own words for what we're doing. We're taking out the effect of debt and bringing it back in, but now we're bringing in Ravi's choice to come up with the debt to equity and the levered beta figure. I now have a beta for the equity in Ravi's company. Why am I doing all of this? Because I don't like regression betas, right? But where did I get the 100 tobacco company betas and the 50 chip company betas? I got them from regressions. So what is the advantage of using an average of 100 regression betas instead of using a single regression beta? Think back to your statistics class. Remember the law of large numbers? What does the law of large numbers say? You can take 100 crappy numbers, put them in a pot, stir them up, and pull the average out, and it's magically precise. I never got this in my statistics class. I think I get it now. When we say that a beta has a high standard error, we're saying some of the betas that we're estimating are too high, some are too low. When I average out my mistakes. The beta that I get by averaging 100 regression betas is going to be 10 times more precise, 10 times more precise than a single regression beta. How did I come up with 10? I make up some stuff as I go along, but 10 I did not have to make up. How did I get the 10? The square root of the 100. I had 50 AI chip companies, right? I take the average of that's going to be about 7 times more precise, roughly, because 49, take the square root. What if I have only 25? Still 5 times more precise. What if I have only 9? It's still 3 times more precise. Anything beats 1. The bottom-up beta basically allows you to make your beta estimate more precise. It's also more proactive, more forward-looking. In what sense? If Ravi entered the AI chip business yesterday, he was a tobacco company, and he decided a lot of cash flows in tobacco, it's a shrinking business, we're going to go into a different business. There is zero chance a regression beta of his returns would reveal that, right? Because I'm looking at the last 5 years. But when I pick the weights, I'm picking them based on the business he's in today. In fact, I can be proactive and say, what other businesses do you plan to be in the next 5 years? And if he says software, I'm going to add a third component. I retain control of this process and reflect it to see changes in your company. So if you think about this process, what do I need to do this for a real company? First, I need to get the answer that I got from Ravi. What businesses are you in? Do companies break themselves down by business? They have to. Accounting requires that if you get more than 10%, and some of the ways they break it up are kind of weird. And when you see Disney, you're going to see what I mean. But they do break themselves down. They're required to. So I'm going to start with that. I have to find the unlevered beta for each business. So then I have to find publicly traded companies in each space. And with Disney, you're going to see the challenges I face. And I'm going to make it real. I'm going to tell you the problems I ran into in trying to come up with an unlevered beta for Disney's businesses and the 2 pathways I use to get around those problems when I run into them. Because you might have to use this for your company when you get the beta. So let me start with Disney's breakdown. In 2013, this is how Disney broke themselves down into businesses. If you don't like the way they broke it down, it's not my fault. I'm just taking what they did as a breakdown. And these are the 5 businesses they told me they were in. The first is what they call media networks. You know what was in there? All their broadcasting businesses, ABC, Disney Cable, and I think they're a piece of Star India, all the broadcasting businesses. They report, and this was nice because many companies don't report anything beyond revenues. Disney broke down revenues, operating income, depreciation, EBITDA, SG&A. So it's a nice breakdown because they've broken down everything for every business. So that's the first business. The second business, of course, is a business we all recognize, right? It's the original Disney business, not really. It's the second Disney business. The original Disney business, of course, was animated movies. Last Friday, my son works at Disney, and I had to, waiting for something, so I went into the office with him. And he took me for a tour around the Disney Burbank building, and he showed me the building that Snow White built, the original building with the dwarfs holding them up. Snow White provided the money to do all of Disney. So it's a company that started with one movie. The revenues from that movie gave birth to the entire company. Theme parks and resorts, of course, includes Disneyland, Disney World. Euro Disney and Tokyo Disney are kind of strange beings because Disney doesn't actually own them. It runs them. It gets a management fee. And now in 2013, Shanghai hadn't opened, but Hong Kong was on the verge of opening. But these are the theme parks and resorts. In addition, Disney threw cruise lines into this grouping. I told you, companies do things, you got to take them for what they're worth. Their argument is nobody gets on a Disney cruise unless you want to see Mickey, and if you're seeing Mickey, it's coming out of the theme parks. Hey, see the logic here. That's theme parks and resorts. Then you got studio entertainment. Those are Disney's movie businesses. In 2013, there was Marvel, there was Pixar, and there was Disney. This used to have Touchstone, Miramax, so luckily they escaped the Miramax curse because before Harvey Weinstein ended up in all kinds of trouble. But they originally owned all of those companies. But these were the three movie companies. Then you had consumer products. There was a time when Disney had a very extensive retail business. There's still a Disney store on Times Square. Now there are like a few dozen, used to be 600 Disney stores. They pulled out of that. They used to make their own products. They don't do that anymore. It's become a licensing business. So Disney doesn't make any of its own stuff. It licenses it. It's a very different business model, right? Because you don't have to deal with the manufacturing and all of the issues with it. You collect a licensing fee. So it's a consumer product business. And in 2013, Disney created a business called Interactive with big dreams because this is the height of computer gaming and they thought they could get into it. 5 different businesses. So my task is laid out for me, right? What do I have to do? I have to go find publicly traded companies in each of these spaces. As I said, I'm going to keep this real because I'm going to take you through the barriers that I ran into, the walls, and how I got around them. The first place was I wanted to find broadcasting businesses. When you think about broadcasting companies in the US, four names come to mind, right? ABC, CBS, NBC, and Fox. And here's the problem. In 2013, ABC was owned by Disney. CBS, I think, was still owned by Westinghouse/GE. I'm sorry, NBC was owned by GE, and you couldn't even find it within GE. CBS was owned by Westinghouse, and Fox was owned by News Corp, a company that is so opaque you have no idea what it owns. Already you can see getting a clean line on a broadcasting company was really difficult. I was desperate. What do you need for the law of large numbers? Large numbers. I'm at 0 right here. So here's my first ploy. I said, if I cannot find companies that do what my company does, I'm going to go up and down the stream of companies that feed into the business, and I'm going to include those companies as companies in my peer group. So I'll give you a couple of examples of companies that I included in my broadcasting business. One is the company that actually syndicates the Oprah show. So it's a show that derives its revenues from syndicating TV shows. And I said, if you syndicate TV shows, you're going to do well when broadcasting companies do well, and badly when you do badly. I included Nielsen, a company that basically rates TV shows, but again is attached very close. So essentially, my objective was to go up and down the food chain, including companies that feed into the food chain. If you cannot find, let's say you're valuing or analyzing a company that does consulting for tourism, that's all their business is, and you can't find other consulting firms, there's no reason why you can't look at tourism companies up and down the spectrum and include them, because they're all affected by the same macro forces. I 26 companies. Would I like more? 26 I can live with. Would I have rather had 100? Yes, but 26 is good enough. And the unlevered beta, and I'll take you through the process of how I do this, that I got was 1.0313. I'll pick one of these sectors and take you through the mechanics of how I got the unlevered beta. But I went through the process of getting the regression betas, cleaning them up for debt, and cleaning them also up for the effects of cash. Sounds mysterious for the moment, but when a company has cash, its regression beta is going to get pushed down. I have to take out that effect, but I have an unlevered beta for the broadcasting business. As I said, I'll return and show you the mechanics of that. Then I went to theme parks and resorts, and I looked for publicly traded companies in this space, and I very quickly ran into a second problem. In the US, there were only 2 publicly traded companies I could find. One was Six Flags, which is a basket case company, huge debt ratio on the verge of disaster. The other is this Midwestern Cedar something company, which is, again, a small, but 2 companies is not helping me very much. So here I decided to go a different way. I went global. I said, why do I have to stay US focused? You're saying, but you can't compare betas across countries. Why not? What's the average beta across all US companies? It's one. The average beta across all European companies, one. African companies, one. Asian companies, one. Betas don't carry the taint of country risk. So when I went global, I ended up with about 20 amusement park companies around the world. So they include companies like Legoland, the company that owned Legoland, publicly traded, I included in the space. Again, I went through the process, get the regression betas, average them out, clean them out, and come up with an unlevered beta. Yes, Ravi?
You're getting betas for those global companies. Are those for different
That's a
index?
That's a good question, and I think that's a very good estimation question, right? Because when you go look it up on Bloomberg for each of these companies, what are you getting? What did I say Bloomberg does? It runs a regression a very parochial way. It runs a regression against the local index. And Ravi's question is, did I take those betas? You know what the law of large numbers does for you? It's very forgiving. Okay? If you have large samples and you have betas against different indices, each might be screwed up by that index choice, right? Sometimes it might be too high because the index is too narrow. Sometimes it's going to be too low. And as with everything else in the law of large numbers, you can afford to be sloppy. So if you have 25, 30, 50 companies, you can afford to run it against the low. If you have 6 or 7 or 8, this decision becomes much more significant. Weekly or monthly, what index should I use? And there, the argument is maybe you should pick a common index, a global equity index to rerun them, but then you'd have to rerun the regressions yourself. You can't pull out the betas from Bloomberg. And I went to the movie business, and that's the business I'm going to focus on. I found publicly traded movie companies in the US. And the US happens to be one of the few countries where movie businesses are actually publicly traded. In much of the rest of the world, they're either privately owned or parts of much bigger businesses. The unlevered beta, and that's the one that I'm going to focus on and take you through. But let me finish this table, and then I'll take the studio entertainment and blow it up. Consumer products, lots and lots of companies. Mostly I took game toy companies, 44 companies as the unlevered beta. And finally, interactive, I looked at global computer gaming companies, and there were 33 companies, and I came up. So if you look at the last column, those are my estimated betas of being in the business. These are called pure play betas. You're trying to estimate a beta for a business. So as I promised, I'm going to take one business, the studio entertainment business, because it's nice and compact, and take you through the mechanics of how to get the beta. I don't know whether you checked your email late last night, and there was a very scary attachment that came with it. You said, what? There's been a case on the calendar for a while. Some of you might have been aware of it. Most of you probably didn't even know there was a case. I attached the case to that email yesterday. So if you haven't, if you trash that email, go pull it out of the trash. You actually don't have to. The case is on my webpage anyway. And the case is about doing an investment project. And one of the things you have to do is come up with a cost of capital for the project. The exercise I'm going to go through is going to be very similar to the exercise you will have to go through perhaps for that project as well. So if there's any mechanical step that you have trouble with, make me stop and go over it because I want to make sure everybody gets it. So here's the entertainment business, the first column. These are all mostly smaller movie companies. You see why they're going to be smaller? Because the minute you become larger, you're going to bring in other businesses in by staying with smaller companies. So you're not seeing, if you look across the list, the largest companies here, I think, are, Lionsgate and DreamWorks and 21st Century Fox. You don't see Warner Brothers up there because it also has other businesses. So I've got the publicly traded companies. I looked up the regression beta. So I call it a levered beta to remind myself it's a regression beta, it's levered, I need to clean it up. Second column is the market cap. Market cap is just the market value of equity, share price times number of shares. Again, it's public information. Then I have total debt, including leases. Remember, this was 2013 when accountants were doing strange things with leases, treating as operating. I converted leases to debt. We'll talk more about why we do that and how we do that, but there's the total debt. So up till there, all I'm doing is pulling up public information. Those are 3 pieces of data you can get for any company that's publicly traded. If you add up the market cap and the total debt, you get what's called the value of the entire firm. But some of that firm value comes from cash. And I'm going to take out the effective cash from the firm value. And I do that, I get what's called enterprise value. The best way to think intuitively about enterprise value is this is what the market is valuing a company's operating assets at. The firm value includes the cash as well. So when you look at a company like Apple, if I took the smartphone business, the computer business, and the services business, the enterprise value captures the value of that. But then you have a $200 billion cash balance on top. So far, all I'm doing is pulling numbers out there. In the last few columns, you basically see the extra data I pulled up. I've pulled up the pre-tax cost of debt and the marginal tax rate. But I compute what I'm going to call a gross debt to equity ratio. I'll just call it a debt to equity. I take the total debt and divide by the market cap, not by the book value of equity, but by the market cap. And you can see the debt to equity ratio is all over the place. Now, if this is a statistics class, what are the two numbers on that column that jump out at you? There's a 477% debt to equity ratio and a 551% debt to equity ratio. And when you average and you got these two really big outliers, you know what that's going to do to the average? It's going to pull the average out. You're saying, so what? If I take that average debt to equity, strange things are going to happen to my unlevered beta. So go back to your statistics class. If you have a distribution where outliers are pushing in one direction, if they're in both directions, they average out. But in one direction, they're pushing it out. I don't know about you, but I was told in my statistics class to look at the median. The median is the middle of the exact halfway through. So I've got the average and the median. I also compute an aggregated number. What's the aggregated number? I add up the debt for all of the companies, add up the equity for all of the companies. It's a neat way to get rid of outliers, especially if they're small companies, which they usually are. It's like a weighted average. So I've got a simple average, a weighted average, and a median number. And I have it for the beta. I have it for the debt to equity. And I also have it for how much cash these companies have as a percent of value. For the moment, kind of hold on to that. The regression beta is 1.24. These companies have about 3% cash out of their firm value and a debt to equity ratio of 27%. I'm going to work with the medians because I think I could use the aggregated values as well. You're going to get a very similar number, but I'm going to work with the medians because I think they're more meaningful here. So what do I have to do? I have to use these numbers to come up with an unlevered beta for the studio business. Yes? That's a good question, which is you could unlever each company's beta, right? It's using its debt to equity ratio. It's a purely statistical reason. When you have noisy numbers, doing operations with noisy numbers creates even noisier numbers. Now, it sounds like I'm talking some Greek, but what I'm basically talking about is you have a debt to equity ratio that's 500, 600%. Use it to unlever the regression beta for that company. You're actually pushing it further away from the truth. So whenever you have noise, it's better to average out first. And the bonus is it's quicker to do. You're not doing 11 unlevered betas or 10 unlevered betas. You're doing it once with the aggregated numbers. So I have a regression beta 1.24. Cash is 3% of value. And the debt to equity ratio is 27%. First, let's get a sense of direction. Regression beta is 11 beta, 1.24, right? But I have a debt to equity ratio of 27%. So what will my unlevered beta look like? Lower than 1.24 or higher than 1.24? The levered beta includes the effective debt. I'm going to take out the effective debt so to make my unlevered beta lower, right? So I'm going to get an unlevered beta for the company. That was my first step. I took out the debt to equity ratio effect. So that's the same equation you saw last session when I took Disney's regression beta and cleaned it up. The unlevered beta that I come up with for being in the movie business is about 1.07. So that's the unlevered beta for a typical movie company. But a typical movie company is 97% movie business, 3% cash. You think, so what? What's the beta of cash? It's zero. That 3% cash is pulling down the beta. And I want to take out the effective cash because I want to just get a beta for the movie business. So it's a pure algebra problem. 97% is movie business, 3% is cash. I'm solving for the beta for the movie business, and that movie business beta is going to be higher than 1.068, and I want the intuition to be clear. You take out the effective cash, the rest of the business has to be riskier. That's what you saw as the unlevered beta for this business. It's a pure play beta. It's basically a beta for being the movie business. So if you look at my beta averages by sector, you'll see this beta corrected for cash. It always throws people off. Maybe I need to come up with a better description of it, but that's exactly what I'm doing in every industry group. I want to get as pure a beta as I can for the business you're in. And I did this for all 5 businesses. Let me pause right there because there's a lot coming at you in terms of numbers. But think of the sequence. You start with the regression beta, it's levered beta. You first take out the effect of debt because you don't want it in there. And then you say, look, there's cash in there. There's a shortcut that some people use, especially in Europe and Latin America, instead of going through this 2-step process. What's the shortcut? Instead of using the gross debt to equity ratio and adjusting for cash, what could I do instead? Constantine? What if I took the debt and netted cash out from it? You get a net debt ratio. If you unlever using a net debt ratio, you're going to get an answer very similar to one. You're saying, why don't you do it? Because I feel more comfortable cleaning up for debt first and then adjusting for cash, because cash could be here today, gone tomorrow. So from that perspective, you want to use a net debt ratio, you're going to get roughly the same answer because you're doing in one step what I do in 2. So now I have 5 businesses and unlevered betas for the 5. What is the next? Once I had that for Ravi, what did I come back and ask him? How much value do you get in each business, right? So I wanted to go back to Disney and say, how much value do you get? Let me go back to how they broke their businesses down. Do you see a value column there? There's revenues, operating income, EBITDA. Companies don't break down divisions by value because divisions don't trade. You can't value, you can hire somebody to value the business, but that's going to be an estimate. These are accounting numbers. So what you have for these businesses is a bunch of accounting variables. I have to convert. If I'm in a hurry, I would use those accounting variables to weight things. But here's the reason you got to be cautious about weighting, for instance, based on revenues. I'm treating $1 in revenue from the theme park business as worth roughly the same as $1 in revenue from the consumer product business, the movie business, the broad, and that's not going to be true if margins are very different across businesses. If I could somehow convert my revenue number into an estimated value, I'd be closer to the truth, right? So let me go back to the previous 2 pages ago. You see the last column? I took the enterprise value that I got for each of these companies and divided by the revenue for each company. The median number that I got was 3.05. You're saying, what does that even mean? Movie businesses, at least if you look on average, trade for about $3.05 times revenue. So if you have $1 billion in revenues, the market attaches a value of 3.05 billion. You see what the next step I'm going to do is? I'm going to take the revenue Disney gives me for each business. There's a 3.05 you saw from that table. I do that for the other businesses. So if you look across businesses, the consumer product business is the least valuable in terms of scaling revenues. You don't make enough money, so it's 0.83 times the revenues. But theme parks, broadcasting, all have about 3. But interactive gaming is low, perhaps because it's riskier, the growth might be more difficult to deliver. Multiplying the revenues by that multiple gives me an estimated value for each of the 5 businesses. You add those estimated values up, you come up with a total value for Disney's operating businesses of 135 billion. Some of you might have heard analysts use this term, sum of the parts valuation. It looks deep and intense, and they did some serious work. This is all they've done. They've taken some metric for each business, applied a multiple to it. Revenues, EBITDA, EBIT, and they come up with a number. They add the numbers up, and they act like they spent 3 days. They might have actually spent 3 days to get to that number, but they should. I mean, this is the kind of sum of the parts valuation you do after a long dinner where you've had too much to drink. And somebody says, can you value Disney? You pull up the numbers, you apply a multiple to it, you add the numbers, I'm done. It's a very sloppy sum of the parts, but I can live with it for what I'm doing, which is to come up with a beta for Disney as a company. And based on my assessment, Disney is about 49% broadcasting, about 34% theme parks, about 13% movies, about 2% consumer products, and about 1.3% interactive products. The only rule is the weights have to add up to 100%. You take the weighted average of my unlevered betas, I have an unlevered beta for Disney as a company. So this is where I was with Ravi. With his two businesses, I now have it for Disney. It was a lot more work to get there because there were in 5 businesses. It was tough to find the comparable companies. But this 0.9239 is the unlevered beta for Disney's operating businesses. Does Disney have, as a company have cash? Yes, it does. If I wanted to get an unlevered beta for the entire company, I would take the unlevered beta I have for the operating businesses, weighted by the value of the operating businesses, take the beta for cash, which is 0, and weighted by cash. So if I really wanted to come up with an unlevered beta for Disney as a company, which I usually don't need for a cost of capital purpose, I can get there by bringing the cash in. Yes. Enterprise value and the value of a company, right? So basically, the value of the business is kind of an amorphous term. Firm value is the value of the entire company, right? You take Apple as a company. The value of the entire company includes the 200 billion in cash. Why? Because the company has the cash. But if I said, what is the value of Apple's operating businesses? You're going to subtract out the cash. That's enterprise value. So when people talk about enterprise value, that's why you net cash out, because you're trying to get an estimate of how much the operations of the company are being valued by the market at. I know when you get a chance, go through the steps. They're not complex, but they're, you've got to go through sequentially. You try to jump steps, you try to do things in a hurry, you can mess up. So, if you have your company already and you want to use your company as an example to get ready for the quiz, it's a great way to kill two birds with one stone. You can get your project done and get ready for the quiz by working with those weights. I now have an unlevered beta for the company, that 0.9239. What's my last step? I'm going to ask Disney, do you have any debt? And Disney does have debt. It has about 15.7 billion. But here's the challenge I face. Disney tells me how much debt they have as a company, but they don't break their debt down by division. You're saying, why not? Because they don't have to. And the money is fungible. The company goes out and borrows money. So when you look at the balance sheets, so I don't have debt by division. The first edition of this book that I wrote, I got to this point, say, Disney doesn't break their debt down by division. I don't know what the debt is by division, so I'm going to take Disney's debt to equity ratio and make it the debt to equity ratio for each of its businesses. Sloppy, lazy, but that was my excuse. They don't break. But we know that some of these businesses carry more debt than others. So the last, after the first year, I tried to start allocating the debt. You're based on what? In this case, I've allocated debt based on what Disney calls its identifiable assets, which are really physical fixed assets. Why did I do this? Because lenders like to lend money on fixed assets. So if you're a business without a lot of fixed asset, my assumption is you can't borrow a great deal. And I end up with debt to equity ratios that are very different across the 5 businesses. So the total debt, I've taken and allocated based on the assets across the businesses. I also allocated the equity that Disney has across the businesses, because basically once I know the value of the debt, I can subtract it from the estimated value of each business and have a debt to equity ratio. I'm almost there, right? I've got an unlevered beta for each business. I have a debt to equity ratio. I apply the debt to equity ratio on the unlevered business. I come up with a levered beta for each business. It's a long journey, but there's a reason why this is so critical if you're a multi-business company. Because if you have different levered betas, you have different costs of equity. And if you believe my numbers, the cost of equity for Disney's operations collectively is 8.52%. But the cost of equity varies anywhere from 7.09% for theme parks to almost 11.6% for interactive gaming. I now have a cost of equity for the company and a cost of equity for each of the 5 divisions. But I was able to do it because I can't do this with a regression beta. There is no regression beta for interactive gaming. There's no, so this is something you can do if you break a business down and build up its cost of equity. Any questions to the mechanics? You look a little dazed. It'll pass. Right? So let's say you got the mechanics nailed down, and you will, if you take it. You've now become the CFO of Disney. You're sitting in your Burbank office, and I'm going to be the movie guy. Why? Because I want the fun job. I come into your office. I barge in. Movie guys never knock. They barge in. Said, we're planning a big budget movie. You're getting ready to throw me out because you know exactly what happens after I plan a big budget movie. Lone Ranger 2, this time without Johnny Depp. Lone Ranger 1 was one of the big fiascos of all time. $200 million budget, made $35 million. But this time, we're doing it right. So what do you mean? So we've hired 5 MBAs to work through the numbers, and they've come up with the return on equity for the movie. No movie guy talks like this. Return on equity is kind of a foreign language to them. But the MBAs have taught me the ROE. So I said, return on equity. I don't even say return equity. I say ROE. The abbreviation always sounds more sophisticated, of 9.5%. So you're the CFO. You're in charge of the checkbook. You have to decide whether to fund the movie. What's the question you have to ask? Is 9.5% a high enough return on equity to take the project, right? You know why I picked 9.5%? It's higher than the cost of equity for the company, but it's lower than the cost of equity for the movie business. So really the choice I'm asking you to make is, when you decide on this project, should you be comparing it to the cost of equity for the company which comes up with the money, or should you be comparing it to the cost of equity of the business that the project is in? Derek, what do you think? In fact, let's open up. How many of you think you should use the company's cost of equity because the company comes up with the money, and therefore if it beats that cost of equity, you should take the project? Okay. Yusuf, Constantine. Yeah. So we have a few. So, Yusuf, I'm going to put you on the spot, right? So let's say you decide to do this. So every business now gets an 8.5% cost of equity, right? Which of the 5 businesses is going to be happy that you did this, and which ones are going to be disappointed? They're going to be happy. What are you asking them to do? Use a higher cost. You remember, when you use a higher cost of equity, you're not going to be able to take as many projects. So they're a safe business. You're putting a higher cost of equity on them than they would have faced otherwise. They're going to be the most unhappy of the group. You know who's going to be dancing in the streets? The interactive gaming people. They're going to say, this is amazing. We're part of the Disney family. Let's play it out, though. So what will this mean? There'll be fewer theme parks built, probably none. A lot of interactive gaming things because you beat it. Over time, what's going to happen to Disney as a company? Its safest businesses will shrink, and its riskiest business will not just grow, but they will overgrow. They're taking bad projects. Why? Because they're being subsidized by the safe businesses. Over time, those businesses that subsidize will shrink and go away. There was a reason Bankers Trust started in the 1980s as a commercial bank. And by the time you got to 1990, Bankers Trust had become almost entirely an investment bank because they played this stupid game of which business has a higher return equity, we'll put our money in it. Commercial banking couldn't compete with investment banking. It was much safer. So over time, it kept kept subsidizing until it disappeared. Half of all global companies do this. They talk about a corporate cost of equity and capital, and that's a terrifying term. Because the minute you say corporate cost of equity and capital, it becomes this discount rate you apply across the board. You're in 26 businesses, you apply one corporate cost of capital. I will safely predict what your company is going to look like 5 years from now. It's not going to be good. First rule in capital budgeting investment analysis is the discount rate for a project should reflect the risk of the project, and in this case the risk of the business is standing in for that, rather than the risk of the entity looking at the project. It could be the safest company in the face of the earth, but you're entering the AI business. Tobacco companies are really safe. But if Ravi took the cash from the tobacco company and he's going into the AI chip business, and he uses the same cost of capital for 2, it's not fair, it's not right. Because the tobacco business cost of capital should be low, and the cost of and this process allows you to come up with different hurdle rates. So if it's that simple, it's the first principle, saying how come so many companies violate that principle? What do you think the reason is that so many companies use a corporate cost of capital as a discount rate across the board. It's easier in what sense? Risk-free rate, equity risk premium are going to be there anyway. You need a beta. Kelly, how do they get a beta? They go to Bloomberg, they look up the beta, and they get a regression beta for a company. For the company, right? There is no regression beta for theme parks. If the way you get a beta is from a regression, you are trapped. There's only one beta for the company. So even if you don't buy into any of my other arguments for a bottom-up beta, this argument alone should be sufficient to say, I'm going to build up to a beta for a company based on the business it's in, because it's in very different businesses. So it's one of the first principles in corporate finance, gets violated all the time. So one is the fact that they get a regression beta. The other is it creates some internal tension within the company. Okay? I'll give you an example. About 30 years ago now, a student from this class had gone on to work at the Gap, and the Gap at that time was just the Gap. Every store was a Gap store. And they then introduced two new variants on the Gap. One was Banana Republic, which is Gap clothes marked up by 30%, but you don't have to deal with the riffraff. A lot of empty stores. And the other was Old Navy, which is Gap stores discounted by 30% and lots of riffraff. So three different businesses. So he calls me after this plan and he says, I remember the corporate finance class and I was thinking through what because at that time they used an 18% hurdle rate for their Gap stores. Don't even ask me how they came up with the 18%, but that was their hurdle rate. And as long as every store was a Gap store, 18% worked. So he was in the finance group and he was thinking about, these new divisions are opening. So you can help him out. If 18% is a hurdle rate for a Gap store, and you think about Old Navy, Gap, Banana Republic, think discretionary, non-discretionary. Tolu, which one of these should have the higher hurdle rate? Banana Republic, because in a sense you charge higher prices, much higher margins. And Old Navy, because it discounts should have. So, and he talked through this and I said, I think I'm going to push in this meeting for having a higher hurdle rate for the Banana Republic, a much lower hurdle rate. I knew exactly the buzzsaw he was going to walk into, but I didn't want to let him in on it. I said, tell me what happens after the meeting. So he calls and he says, it did not go well. I said, what happened? He said, one of the divisional heads did not like the idea at all. I said, let me guess. Was it the Banana Republic guy? He said, yeah, he really didn't like the idea at all. I said, what did the CEO do? He said, the CEO for the moment thinks of the Banana Republic as one of his star divisions. He doesn't want to rock the boat. So for the moment, we're going to continue to use 18% hurdle rates across the company, because introducing different hurdle rates requires that you put your foot down. You're a risky business. You should be earning a higher return. And if that risky business is your high growth business, and that person pushes back, then you're going to be willing to take a stand. One of the worst culprits on this is banks. There was a time when if you looked at a bank, it did banking things. What are banking things? You take deposits, you lend them out, you make money on the spread. And starting in the 80s, what did banks do? Non-banking things, real estate, trading, investment banking, all exciting, high growth. But if you were sensible in the bank, as you entered these new businesses, you should be saying, look, we have limited equity. If we're investing it in these riskier businesses, we should be demanding a higher hurdle rate, but not one of them did that. So over time, what's happened to every single bank that's entered these spaces? The non-banking side has essentially overwhelmed the banking side until you hit a crisis. Right? So when you enter riskier businesses, you need to set the threshold higher, because it's not because you're being greedy, but because you're being prudent. So go ahead.
So I get when companies have multiple lines of business, but let's just say there's a company that has one line of business.
Okay, let's take one. So let's make it specific. Give me an example.
I'll just take my company. I'm doing Shake Shack.
Shake Shack.
So
it's one business. Yeah. But would you still need a bottom-up beta, even though you're in one business?
That?
Would you still be able to need a bottom-up beta, even though you're in one business?
Yeah, I guess.
Why? Because the other rationale, you don't need multiple business betas. You don't need to be proactive. What's the advantage you get with a bottom-up beta for restaurants instead of using the Shake Shack beta?
It's just that, still that law.
Law of large numbers. So even in a single business, you still will use bottom-up betas. And if Shake Shack at some point in time decides to go with the lower price version, let's face it, Shake Shack is more upscale. It kind of is in the big cities. It's not a McDonald's. It's not an In and Out. It's not a, if it decides to go with maybe a lower cost version, which is an opening, you will be in a position to say you can't apply the corporate cost of capital you've been using so far. Let's talk about ways in which you can estimate the beta. Or it could go upscale. So we're going to introduce, there are high price burger joints, $50 a burger. We're going to go after that market. And it might be a much more niche market. You're ready in case that happens, because at some point in time, as companies scale up, whether they like it or not, they often have to look beyond the business, because that's how you continue to grow. Okay. Any other questions? Yeah. I'm going to now try to get a bottom-up beta for Vale. Okay. Vale is in 4 businesses. Again, I took this right off their financials. Now, first 2 are mining businesses. One metals and mining, and the second is iron ore. They're fundamental businesses in iron ore. They started as an iron ore company. That remains the heart of their company. But they have 2 other businesses. One is a fertilizer business, and the other is a logistics business. They gave me the revenues for each business, and I did exactly what I did for Disney. So I won't bore you with the details. The one thing is, when I computed the averages, I used global averages, not just Brazilian company averages. Why? Because if you think the law of large numbers, is an issue, and with U.S. companies, you're always going to find enough sample, even if you stay U.S. centric. You go to Brazil, you go to Portugal, you're going to get much smaller samples if you say country focus. So even bigger need for global. And the other is, these are mining businesses. Mining businesses, it doesn't really matter whether you're a Brazilian mining company or Australian mining company. What do? They extract stuff out of the ground and they sell it into a global market that's a dollar-based market. An oil company. No reason to stay focused on Latin American oil companies or European oil companies. So you notice I use global for all 4. Sample size varies widely. For the fertilizer business, where I use specialty chemical, there are 693 publicly traded companies. This is overkill, right? I mean, think about the savings you're going to get with 693 companies, but since I have them, might as well use them. I came up with the unlevered beta for these businesses, just like I did for the studio business. If I had to do this by hand, I'd restrict my sample size to 10 or 15 or 20. If you're doing it in Excel, what difference does it make? So I use median numbers for all of them. I take a weighted average based, again, on the estimated value of the business. And based on my estimates, it looks like Vale is about 76% iron ore, about 17% mining, about 5% fertilizers, and 2% logistics. Again, the weights add up to 100%. I have an unlevered beta for Vale as a company of 0.844. Here again, I can estimate a cost of equity for each business, and I chose to do my assessment entirely in US dollars, even though it's a Brazilian company. Why was that? It's a commodity company. Commodity companies actually around the world often report their financials in dollars because they live in a dollar-based world. Right? So it's not because I was trying to be dollar-centric here. I said, look, I could have done it in reals, but it's actually better to do it. It's easier to do it in dollars. So my risk-free rate is the T-bond rate. The equity risk premium, if it's been a while back, was the weighted average of where Vale gets its revenues. And I have a cost of equity in dollar terms for each of the businesses and for Vale as a company. So what does that mean? You can see my cost of equity for fertilizers is going to be higher than my cost of equity in logistics. But notice that the differences are smaller across the businesses. Here you could get away with using a corporate cost hurdle rate, but it's by accident. So if you're in businesses that are very similar to each other, you're BHP and every business you have is a variant on a mining business, you might be able to get away with a corporate cost of capital. But it's only because of that accidental closeness they have to each other. I did give them all the same debt to equity ratio because they're all infrastructure businesses. They all need big investments up front. There's nothing that stood out and said, you know what, maybe I should think about a different debt to equity ratio, because it is a bit of a mess allocating debt across businesses, and you saw that with Disney. Let's say I do this, I take it up to my managing director, and he's a pain in the neck. He says, I don't want anything in dollars, I want everything in reais. You say, God, I went through all this work. Hey, don't worry, it's actually very simple to convert a dollar rate into a real rate. And if you remember how we did this with the risk-free rates, all you have to do is bring in the differential inflation. So all I did was I took the cost of capital I had in dollar terms, 11.23% for the company, estimated expected inflation in Brazil and the US, 9% and 2%, and there's my real cost of capital, 18.87%. Could I have done it by going back to a real risk-free rate? Yes. The answers might not match, but I could take the government bond rate in real, subtract out the risk-free rate. Essentially, make your choice. If you want to pick a currency and you come up with the cost of capital, and if you want to switch currencies just to see if you can do it, try to do it in a different currency. See what the cost of capital would look like. Right? Last two companies, Tata Motors, actually last three, I started with the beta for automobile companies. Again, I started Indian automobile companies and I very quickly realized I had a problem. Only three of them, so I went global. And especially with Jaguar Land Rover becoming part of Tata Motors, I didn't see a need to stay emerging market focused. The unlevered beta was 0.86. I did briefly consider breaking Tata Motors into luxury automobiles and mass market automobiles. But in 2013, there weren't enough publicly traded luxury auto companies. There's a BMW, maybe you could throw in there. Today, you can throw in Ferrari. I mean, but that's a very different business than any other luxury auto company. So basically, I left them as an automobile company. I came up with an unlevered beta of 0.8601, and then I used Tata Motors tax rate and Tata Motors debt to equity. So the unlevered beta comes from the business for whatever business you're in, but it's your company's tax rate and your company's debt to equity ratio that gives you a levered beta. Here, I did everything in rupee terms. There's my rupee risk-free rate. There's my bottom-up beta. There's the equity risk premium based on where they operate. 14.49% cost of equity in rupee terms. The way currency enters in is through the risk-free rate, right? It's not the beta. It's not the risk premium. It's through the risk-free rate. Any questions on the Tata Motors? And for Baidu, the levered beta that I get is 1.356. Now, based on the unlevered beta being in the online advertising business, companies in that space, they have very little debt, 5.23% debt to equity ratio. We'll talk about why they have so little debt, but clearly that's all they have. Levered beta 1.36. In renminbi terms or yuan terms, the cost of equity is 12.91%. Risk-free rate, risk premium, beta. So reminder again, risk-free rate is a currency, equity risk premium reflects where you operate, the beta reflects the business you're in. The bottom-up beta is now replacing the regression beta for each of these companies. Finally, I looked at Deutsche and I broke them down into two businesses, commercial and investment banking. I don't know why it does the wrong thing here, but it should be the commercial investment banking. Okay. Commercial banking, I looked at commercial banks in Europe. For investment banks, I had to look at global investment banks because most European investment banking is within the commercial banking arm. So it's only in the US you have Morgan Stanley, Goldman Sachs. So I broke them down to two businesses. But here's the difference, and I want you to think about why it is. I took the average beta for commercial banks and the average beta for investment banks, and I left them. What's the step I'm skipping here that I did for the other? I didn't unlever and relever. Why do you think that is? What do I need for unlevering and relevering? You need debt. And debt for a bank is an absolute nightmare. Right? I'm not even sure debt to a bank is a source of capital. It's raw material, right? Technically, the deposits you have in a bank are debt. And if you define that as debt, God help you, right? 97% debt, 3% equity. So with banks, what you do is you avoid the levering and unlevering. You say, please God, let the regulators be doing the job because you're not exactly going to get an all equity funded bank. They all borrow money. They borrow up to regulatory limits. And you're throwing up your hands and saying, I'm just going to take the levered beta and I'm going to use it for my cost of equity. Could it get into trouble? Yes. Because if implicitly, what am I assuming? All banks are equally risky. And one way you can start separating that out is you can look at how overcapitalized or undercapitalized a bank is. Maybe you can tie the bank to regulatory capital and whether they're doing it. I don't want to go there in this calculation. So what you get there is a bottom-up beta for Deutsche. The only difference is I'm looking at the levered betas and taking a weighted average of the levered betas. At the time that I did this, you can see the breakdown of the two gave me a higher cost of equity, which is what you'd expect for investment banking than commercial banking. Deutsche wasn't doing this internally, and maybe that's part of the reason Deutsche is in the trouble that it is now, is it let the investment banking arm essentially run amok for a while. And after 2008, it's been trying to rein it in, but the damage has already been done. The reason you need to demand a higher cost of equity for riskier business is there will be 2008s in your risky business. And you have to be more cautious in how you enter the business, because after the fact, it's much too late. So let me I know I told you at the start of the class, I warned you that a lot of stuff is coming at you. So go back and review the stuff, that table that I'll fix that table, because basically that table that had the holders should be really the table of investment banking and commercial banking. But if, take a back and think about a bank like JP Morgan, right? Think about the different business it's in. Trading might be a separate business, investment banking might be a separate business, real estate might be a third business, and then think about how different the hurdle rate should be within that business. The last thing I want to talk about today is getting a beta for a private business. I mean, so far I've talked about 5 of the 6 businesses I said I was going to talk about in the company, right? It's all publicly traded. But remember that 6th business I mentioned at the start of the class that I've kind of never gone back to, Bookscape, that privately owned bookstore in New York City? Do they need a hurdle rate? No, they have to make investments too. I'll tell you the story of how Bookscape ended up being in this book. Long time ago, owner of this bookstore walks in. I had no idea who she was. She walks in and says, I own this bookstore, and she gave me the name of the bookstore. I've changed the name to kind of, keep it anonymous. And she said, I've owned this bookstore. My grandfather started the bookstore. We have a great location. We have a good history, but I'm facing an existential threat. And I'm saying, what do you talk to me for? Right? She said a Borders is opening. This was when Borders was this high growth bookstore. Borders is opening down the block from us. And I'm faced with the decision of either abandoning the bookstore and I'll get $2 million, $2.5 million because it's a great lease. The lessor will pay me $2.5 million to go away, or staying and fighting. I said, what does staying and fighting require? She said, taking the rest of my wealth and putting into the bookstore, opening up a coffee shop, a restaurant, the things that Borders has, kind of upscaling. So I said, what are you talking to me for? She said, I need to know what rate of return. She didn't use those terms specifically. I need to make on my investment to make this expensive. She wanted a hurdle rate. To which your question is, how have you run a bookstore for 50 years without a hurdle rate? Because your grandfather started the store, it's the right location. You're not exactly facing big investment decisions, right? Lots of private businesses can coast for a long time without ever confronting the question of, what do I need to make? Now she was faced with the question. She said, can you help me? She gave me this $200 coupon to the bookstore, which I took, and I said, okay. So here's what I did. I went in, so if you think about it, what's the challenge you face with a privately owned business? There's no regression beta. That's off the table. I can try with accounting earnings, but that's a mess. But can I get a bottom-up beta for private bookstore? What do I need for a bottom-up beta? Tell me what business you're in. So here's what I did. I went looking for publicly traded companies in the book space. Initially, I looked at bookstores, but there are only about 3 or 4, so I added publishing companies to the mix. And I looked up their regression beta. So what you see on this page is very similar to what I did for Disney. Pull up the regression beta, unlever it, clean up for cash, came up with an unlevered beta for being in a bookstore business, 0.7205. You can, that's overkill, the 4th decimal point, so 0.72. And of course, we clean up for cash, just like we did for the studio business. You can come up with so far, it looks like I'm doing exactly what I do with public companies. And I am. The unlevered beta is 0.76. Now I run into the second challenge. What did I ask Ravi after I came up with an unlevered beta? I asked him for a debt to equity ratio, but it's supposed to be a market debt to equity ratio, right? For Disney, that wasn't a big deal. There was a market equity number, but this is a privately owned bookstore. He's saying, why not use book debt to equity? That's not even a choice. God only knows what book equity measures, but it definitely is not a comparator. So what I did effectively was I said, look, bookstores have a typical debt ratio, publicly traded bookstores. You're a bookstore. The debt usually takes the form of leases. You probably have a lease as well. So I used the debt to equity ratio of publicly traded companies to lever up the beta. So already you can see if you're working with a private business, you can come up with an unlevered beta. But to get the debt to equity, you have to kind of look to public companies again, and that's what I'm doing. I've actually tried calling private business owners and say, do you have a target debt to equity ratio? And their reaction is, a what? That kind of answers the question. Now, maybe if you're a private business person and you said, my target debt to equity ratio is 25%, I can plug it in. But I've almost never got a usable answer when I ask that question. I ended up with a levered beta of 0.86. I'm almost there, right? Risk-free rate plus beta times equity risk premium. I'm doing things in dollars. Gives me a cost of equity of 7.5%. I almost called the lady to collect my coupon and give her this cost of equity, but there's one big problem with this cost of equity. How did I measure risk? With the beta, right? With the CAPM derivation, to use beta, what do you have to assume? That the marginal investor is diversified. What did this lady say right at the start of her pitch? She said, I'm going to take the rest of my wealth and put it in the bookstore. This is the exact opposite of being diversified, right? So I'm going to ask you an intuitive question. If 7.5% is the cost of equity you demand as a diversified investor who can get rid of the risk, would you demand a higher cost of equity or a lower cost of equity? Should be higher, right? Because you have to bring in the rest of the risk. I remember running into this question 30 years ago when I looked at private business. I looked everywhere. There was no, people said, just add an extra 10%. I said, why? Because that's what everybody does. I said, that doesn't work for me. So I went back to basics. Let's think about it. You have total risk in a company. Let's say 100 units of risk. 20 units of market risk you cannot diversify away, and 80 are diversifiable risk. What do I capture with the beta? I capture the 20 units of market risk. I assume the remaining 80 get diversified away. I don't have that choice here. I'm not diversified. I'm going to be exposed not just to the 20, but to the entire 100 units of risk. You see what I'm going to try to do, right? I have the beta. If I can somehow scale it up to include the risk that is company specific, I'm going to come up with, let's call it a total beta. That's a concoction I came up with. Total because it captures total risk. Why? Because you're exposed to total risk. You think, how in God's name am I going to figure out how much of the risk in a company comes from company-specific risk? Is there a number that we've looked at already that tried to measure that? Remember that Bloomberg regression page? There was a slope, there was an intercept. What else was there? An R squared, right? What did the R squared measure? The percentage of variation in the stock that is due to the market. I have publicly traded book companies. Go back to 2 pages. The last column, I've collected their R squareds. The average R squared across, let's say let's stick with the median R squared is 26%. 26% of the variance in a typical book company comes from the market. The remaining 74% is company specific. And this person, this owner is going to be exposed to that 74% as well. So here's what I'm going to do. I'm going to take the market beta of 0.86, which I got by doing the bottom-up beta. And I'm going to divide it by the square root of the R squared. I'm going to ask you a stupid question, but kind of humor me. What's the square root of R squared? R, which is a correlation. So basically, I'm using the correlation. Why am I using correlation? Purely statistical reason. R squareds go with variance. Correlations go with standard deviation. Beta is a standard deviation measure. And half the standard deviation in the stock comes from the market. I end up with a beta 1.68. Now I can use that beta because that beta captures not just the market risk, but the rest of the risk in the company. You plug it in, you come up with a cost of equity of 12%. 11.98, but that's false precision, 12%. So I called her and I said, the hurdle rate is about 12%. Then she asked me two questions, one which was easy to answer. The second, I knew the answer to, but I couldn't think of a kind way to give her the answer. She said, Borders is a publicly traded company. They're opening a store down the block. What will their cost of equity look like? What's the answer to that? Their investors are diversified. They can get rid of firm-specific risk. They're going to have a cost of equity of about 7.5%. I said, that's. Then you can see the second question coming, right? She said, if their cost of equity is 7.5% and my cost of equity is 12%, how the heck am I going to compete with them over time? What's the answer to the question? You cannot. So what's going to happen to private businesses over time? They're essentially going to become public, not because private business people don't work hard. They might work much harder than managers of public companies, but because the way they're taking risk is not efficient. They're putting all their wealth in it. It's all, I mean, if you think about what's happened over the last 40 years and you look at businesses, I'm old enough to remember when you walked into a pharmacy in the US, the owner of the pharmacy was usually behind the counter. 1980s. Today, I challenge you to find an independently owned pharmacy in New York City. You walk to Dwayne Reed, there's CVS, there's chains that own it because over time. Business after business, this happens. And it's almost inexorable. You're almost not going to be able to stop it from happening. No, it's as you know. I'll tell you the levels to which it's gone because of especially with the entry of private equity. I grew up in a part of India, Chennai, where you had these small shopping areas where the shopkeepers own their small shops. You'd go in. Last time I walked down that area, I haven't walked in a long time. I run into a shopkeeper who's been around 40 years, and I say hi to him, and he says, and he's looking very prosperous, wearing new outfit, stores. I said, what happened? He said, I sold a half my store to, he gave the name, it's a private equity. Private equity has essentially come in, bought the half the business, essentially allowed him to cash out on half the business, and he's basically getting the benefits of a diversified investor willing to pay a higher price because, or in the form of roll-ups, right? Lots of businesses which started as private businesses. At one point in time, every video rental company was privately owned. And then came Blockbuster, which rolled up independent video rental stores to make it into a chain. The last holdout was real estate. Real estate for the longest time was, private developers in every city. You need localized knowledge. But look at the real estate now. The biggest real estate owner in the US is BlackRock. Why? Because they can compete against private developers and they don't care about localized risk. It averages out to them. So if Houston goes down 7%, but Los Angeles is up 5%, you have a portfolio. You're a private developer in one area. You got to demand a higher discount rate to reflect all those concerns. I know we have the sentimental attachment to mom and pop stores, and I'd love to be able to deal with the business, the owners behind the counter. But even businesses like plumbing and electric, would used to be privately owned, increasingly you're seeing that happen. And it's coming for healthcare. Now, one point in time, you walked into a doctor's office, it was a private practice. The doctor owned the practice. Today, you pick a doctor, they're part of this chain that is part of a bigger chain, that's part of an even bigger chain. It's at the top is a publicly traded company. So the next time you get pissed off at something like that happening, it's coming from this underlying problem of if you're not diversified, you put all your wealth in one business, it's not. So you're saying, why do people start businesses? Why do people start tech businesses? What do they hope? What's the exit strategy there? They don't want to stay private. They want to take it public. But you do have people who will start private businesses and run it because they love running a business. I call it getting emotional dividends. You make only 11% from the business. You could have made 18% by investing in a mutual fund of similar. It's your business. You like being the business. And it works until you get to be 75 years old and you turn to your son or daughter who's 45 and say, would you like to run the business? They've noticed you running ragged, 16 hours a day for the, no, 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 I'm not interested. When you get that generational shift is often when you get these private businesses dissipate. I'll tell you a story though, but there used to be these auctions. I don't know whether you still have them, where faculty would give things to, and what can we auction off other than services? So I offered to value a company for somebody if they won the auction. So an MBA wins the auction. He walks in, and I expect a small business. He's going to ask me to value it. He comes with this 300-page document, and I said, what business? He said, we're a rum company in Florida, and we're a family-owned rum company. I said, that's interesting. How long have you been around? He said, about 300 years. It's Bacardi rum, right? Privately owned still. Why? Because if you drink enough of your product, maybe you don't care about diversifiable, non-diversifiable risk, but you do get these family businesses that last a long time. But they stay focused, they stay small, and the owner say, that's okay. Kongo Gumi, which is this Japanese company, lasted 1,500 years, but they worked on Buddhist shrines, and that was their core business. They stayed in the core business. You know? So essentially, you do get family businesses that stay privately owned, but they stay in a small niche where no public company wants to enter, right? I mean, how big is the shrine building business? Not like a big public company enters the space. But you got to create a niche in a sense if you're a private business where you're okay with the fact that you might not make as much money with that capital invested in some fund somewhere, but you're getting something else from it. So what I'd like you to do is take your company, look for that breakdown of businesses. This all presupposes, again, that you picked a company, so I'm going to not even ask you that question anymore. Look at the breakdown of businesses. You might not do this until after the quiz. Obviously, the quiz becomes your first priority for the moment. But take your company, break it down by business, and sometimes you might face challenges of what are the companies I should look at. So the last thing I will talk about is being creative in your company choice. I was once asked to value a five-star restaurant in New York City by a friend of a friend. He said, can you do this? Five-star restaurant was owned by a French chef, and it was being bought by this publicly traded restaurant company called Arc Restaurants. So first, total beta is out of the picture because you're selling to a publicly traded company. You should just be looking at diversified investors in beta. So it's not your diversification that matters, the buyers. So he said, can you help me? And I said, okay, he gave me the numbers on the restaurant, the number of, seatings he has, etc. I learned more about the restaurant business than I ever wanted to. But then I go looking for publicly traded restaurants, and the list that I look at, I said, this isn't going to work for me. Because you pull up publicly, you get Chipotle, you get McDonald's, you get Burger King. You go to a French chef and say, here are your publicly traded peer group. He's not even going to look at the rest of the numbers. How dare you compare me to McDonald's, right? And it also doesn't make sense. Who eats at a five-star restaurant? $250 for appetizer, entree, and dessert, not counting the wine. There are only two groups of people who have that much money. One is maybe billionaires or the other is people spending other people's money. And within that group of people who spend other people's money, there you have lawyers and bankers. You know what I did? I used the beta for investment banks as the beta for the restaurant. He said, but I'm not an investment bank. So I came ready. I actually showed him a table of revenues at five-star restaurants the Restaurant Association of New York maintains, and revenues at investment banks. And I showed the correlation. I said, look, when investment banks do well, your seats all fill up. They do badly, they're all empty. So when you think about risk, what you're looking for, companies that do well when you do well, do badly when you do badly. And once you've got that, that is you're not pricing companies. You're not looking at PE ratios. You don't have to worry about all the rest of the stuff. This is about market risk, and you're trying to find other companies with similar market risk. So be creative. Don't get, in banks, you often get people getting SIC codes, NAICS codes, 4-digit codes, look up companies. That's incredibly rigid, and you're missing the point. You're missing the point about what you're trying to do here. And if you haven't accessed Capital IQ yet, I know we've been harassing you about it. this is the time to do it. Maybe right after the quiz, get on Capital IQ because you can pull up those companies, you can pull up the market cap. It's a 2-minute job for any sector. You can pull up all of the information you had there. You could do the long way with the Yahoo Finance, but why, right? So I will see you on Monday again. Remember, 10:30 to 11 is your quiz, and then we have class. So don't leave after the quiz. Hang around.
I'm Camila, by the way. I emailed you a few weeks ago that I'm not going to